3 in the morning. The Treasury market is frozen. Phones light up in Beijing, in Riyadh, in Tokyo, in Brussels. Somewhere in Washington, a screen flashes red as a routine bond auction fails to attract buyers. And in that quiet, technical moment, no explosions, no breaking news music, the world changes. Because for the first time in nearly a century, countries no longer need the US dollar. That's the scenario people whisper about. The dollar's collapsing. BRICS will replace it. America's finished. But what would actually happen if the US dollar lost its reserve status? Not the headlines, not the drama, the real mechanics, and the uncomfortable math underneath it. Let's start with something simple. Right now, the US dollar is not just America's money, it's the world's operating system. Roughly 60% of global foreign exchange reserves are held in dollars. Most global trade, oil, commodities, shipping contracts, aircraft leases, is priced in dollars. Banks borrow in dollars. Corporations issue dollar-denominated debt. Even countries that dislike US policy settle transactions in dollars. Why? Because everyone else does. That's it. The dollar's power is less about patriotism and more about plumbing. After World War II, the Bretton Woods system made the dollar convertible to gold. That ended in 1971. But something more powerful replaced gold: trust and scale. The US had the deepest capital markets, the largest economy, the most liquid government bond market, a relatively stable legal system, and a military presence that quietly underwrote global trade routes. The result? If you're a central bank in Malaysia, or Brazil, or Norway, and you need somewhere to park hundreds of billions safely, there's only one market deep enough to absorb it without blinking: US Treasuries. That's the core. Reserve status means global demand for your debt. Now here's where it gets interesting, because that demand gives the United States something extraordinary. It can borrow at lower interest rates than it otherwise should. Year after year, the US runs large fiscal deficits. It spends more than it collects in taxes. The national debt now exceeds $30 trillion. In most countries, that trajectory would trigger a currency crisis. But global investors still buy treasuries. Why? Because they need dollars to trade. They need dollars to service dollar-denominated debt. They need safe collateral. And US Treasuries are the cleanest shirt in a messy global laundry basket. So when people ask, what happens if the dollar loses reserve status? What they're really asking is, what happens if that automatic demand disappears? Imagine central banks slowly diversify away, not in a dramatic overnight dump. That would hurt them too. Instead, they reduce new purchases. They add euros, gold, maybe yuan, maybe something else. Gradually, structural demand for treasuries weakens. Now let's follow the chain reaction. Step 1, interest rates rise. If fewer foreign buyers show up at treasury auctions, yields must increase to attract capital. Higher yields mean the US government pays more to borrow. And here's the uncomfortable math. When you're carrying tens of trillions in debt, even a small increase in average interest rates explodes your annual interest expense. Interest payments begin consuming a larger share of the federal budget. That crowds out other spending, defense, social programs, infrastructure, or forces higher taxes, or forces even more borrowing at higher rates. Step 2, the dollar weakens. Less global demand for dollar reserves means less structural demand for the currency itself. A weaker dollar makes imports more expensive. Energy, electronics, machinery, pharmaceuticals. Inflation pressure builds. Now pause. You might be thinking, a weaker dollar boosts exports, right? Yes, in theory. But the United States is a consumption-heavy economy with global supply chains. Many American products contain imported components, so currency weakness isn't a clean win. Step 3, Financial market volatility increases. The dollar is the foundation of the global collateral system. Banks use treasuries as pristine collateral in short-term funding markets. If confidence in treasuries erodes, not collapses, but erodes, risk premiums across the financial system rise. Emerging markets that borrow in dollars face tighter conditions. Corporate refinancing becomes more expensive. Global liquidity tightens. The irony? A move away from dollar dominance could initially trigger global instability, which might drive capital right back into the dollar in a crisis. Because when the world panics, it still runs toward US treasuries. That's the paradox. Now let's confront the hype. There's a popular narrative that a new currency bloc, often grouped under BRICS, will dethrone the dollar. But replacing a reserve currency is not like launching a new app. To replace the dollar, an alternative must provide massive, open, liquid capital.